welcome to the deep dive. You're probably expecting this briefing after, well, a pretty seismic weekend in the market.
Seismic is right.
We're jumping straight in because Bitcoin, it did it. New all-time high, closed decisively over that huge $125,000 level.
Yep.
So now the market's really in what analysts are calling, high-altitude consolidation. Pure price discovery mode.
That's exactly where we are. And it's important for you to realize that if you're looking at the charts this morning, yeah, you'll see a bit of a dip. Prices maybe around $123,900, down about 1.2% maybe in the last 24 hours.
Okay.
But let me stress, this is not a retreat. This is like a crucial, technically necessary pause.
Right. Need to breathe.
Exactly. When you get these massive, super fast gains, the market just has to stop, digest it, validate that new level. We're basically building the foundation right now for whatever comes next.
Okay, let's unpack this then. We know where we are, but how did we get here? What pushed us through that massive 125K ceiling? Our sources seem to point to two big things, sort of reinforcing each other.
Yeah, that sounds right.
First, you've got the sheer chaos in the macro and political world driving the story.
The narrative.
And then underneath that, you've got this verifiable, steady institutional demand. Real money coming in.
That combination, the narrative and the structure, that's the whole story of this move, really. If you want to simplify the dynamic right now, the market is basically trying to balance two competing things. On one hand, you have this really strong long-term structural outlook. Scarcity, institutions getting involved.
The bullish case.
Right. But on the other hand, you've got some very sharp, very immediate short-term tactical risks. Stuff that could cause some serious volatility, like right now.
Okay.
Understanding how those two sides are playing off each other, that's kind of what we need to figure out today.
All right, let's start with the big catalyst everyone's talking about. The U.S. government shutdown. It's now, day 6?
Day 6, yeah.
And this whole mess seems to have really solidified Bitcoin's core narrative, hasn't it?
Yeah. Oh, absolutely. What's fascinating here is how analysts are framing this specific moment. It's like the textbook debasement trade playing out right in front of us.
Explain that a bit more.
Well, investors everywhere are looking at the U.S., the world's reserve currency issuer, and they're seeing, escalating fiscal problems, political gridlock, just instability.
Right. Not a good look.
Not at all. So they're looking for hedges. They're moving capital into assets that are scarce, that aren't controlled by any one government, assets outside the system that seems to be, kind of shaky right now.
And it's not just Bitcoin, right? This proves the broader macro point. We're seeing gold hitting new records too, above $3,900 an ounce.
Exactly the same hedge. But the sheer scale of the Bitcoin move tells you something else is going on, something specific to Bitcoin this time.
Because in past shutdowns like 2018, 2019, Bitcoin didn't really act like this safe haven, did it?
Nope. It just wasn't accessible enough back then. Analysts, Standard Chartered, De Beer Group, they're all saying the same thing. The huge difference now is the ETFs. The regulated, liquid, U.S. spot Bitcoin ETFs.
Right, they're the structural bridge.
Oh.
Before, maybe big money believed the debasement story.
Yeah, the thesis was there.
But they couldn't easily act on it.
Yeah.
Now, these ETFs, they just let institutions allocate billions to this macro hedge with, a click. Simple. Regulated.
Exactly. Massive friction removed. The idea was always there, but the plumbing, the delivery mechanism, that's what unlocked this price action.
Okay.
And speaking of catalysts and friction, the single most important thing to watch in the very near term is happening today, October 6th.
What's up?
The U.S. Senate. They're scheduled to reconvene. There are some key funding votes set for this evening around 5:30 p.m. Eastern.
Okay.
Now, and it's probably an if they somehow reach a deal, if the government reopens, that immediately takes away that urgent safe haven bid we've seen build up over the last week.
Which could trigger a sell the news event.
Potentially, yes. That introduces some serious tactical risk.
Okay, so the political drama gave us the narrative push. But what about the technicals? Is the market strong enough to actually hold this new altitude? Can we defend 125K or close to it?
Technically, yeah. The challenge is very clear. We blew past the old highs, so we're literally in uncharted territory on the charts.
Right. Price discovery.
So the market has to prove that the old ceiling, let's call it the $124,000 to $124,500 zone, it has to prove that's now a solid floor, new support.
And this current dip is the first test.
This consolidation we're seeing right now, this is the first significant test of that critical zone. If we hold it, that confirms the breakout. If we break back down below it, well, that suggests maybe we went up too far too fast.
But even if the long-term structure looks good, you mentioned short-term risks. The indicators are flashing red, I hear. Overbought.
Yeah, seriously overbought. We're seeing some extreme readings on the short-term momentum indicators.
Like what specifically?
The Daily Relative Strength Index, the RSI, it's sitting at or even above 78.6.
And for listeners, what does that number actually mean?
Practically speaking, it means there's been intense, sustained buying pressure very recently. The price has gone up very fast. Technically, the asset is kind of top-heavy. It's overdue for either a correction, a price drop, or at least a period of sideways consolidation just to let those indicators cool off, even if the fundamentals are screaming higher long-term.
The price needs to chill out a bit.
Basically, yeah. Just needs to reset those oscillators.
Okay, here's where it gets really interesting. Let's talk derivatives. You said that's the biggest tactical risk. What are the numbers telling us there? Caution or complacency?
Oh, it's signaling a pretty dangerous level of complacency, honestly, which directly translates into systemic risk. The leverage out there has just surged.
How much?
Total open interest in futures contracts, it just hit a new record high, $47.8 billion.
Wow. Billion with a B.
Yep. That is a staggering amount of borrowed money betting on the price. It's up 7.7% in just 1 week. Tells you speculators are overwhelmingly bullish, maybe too bullish.
But hang on. If institutions are pouring in $3.2 billion in spot buying through the ETFs last week, isn't that real demand strong enough to soak up any wobble from the derivatives guys?
That's the crucial question, isn't it? And the answer is probably not, especially if things turn sharply. The derivative market is built for speed, for volatility.
How so?
Right now, the funding rate for perpetual swaps, basically the cost to hold a long position, is decisively positive. People are paying a big premium to stay long, to bet on prices going higher.
So everyone's on the same side of the boat?
Pretty much, and that creates the absolute perfect setup for what we call a long squeeze.
Okay, walk us through what a long squeeze actually looks like. It's not just traders losing their shirts, right? It impacts the price for everyone.
Exactly. It becomes a forced selling cascade. Picture this. The price dips, even just a bit maybe because, say, the Senate does get a deal done tonight.
Right, the catalyst disappears.
Those super leveraged long positions, they instantly become unprofitable. Because they're leveraged, the exchanges automatically force liquidate them, sell them off.
To cover the losses.
Right. And that triggers a flood of sell orders hitting the market all at once, which pushes the price down further, which triggers more liquidations. It cascades.
Dominoes falling.
Precisely. Dumping coins rapidly, violently driving the price way lower than maybe the fundamentals justify. It can be a temporary but really brutal flash crash, driven purely by deleveraging. And that, right now, is the single biggest risk we need to manage today.
Okay, so that's the scary short-term picture. Heavy tactical risk.
Yeah.
But let's balance that against the fundamental strength you mentioned, the stuff that's actually validating this 125K level. Pivot back to that structural foundation. What's the hard proof of institutional conviction?
The proof is in the flows. Hard numbers. U.S. spot Bitcoin ETFs, they saw massive net inflows last week, over $3.2 billion.
Billion.
Just last week. That's one of the strongest weeks they've had since they launched. This isn't just noise or speculation. This is a serious structural bid. It confirms that big players, institutional treasuries, wealth managers, they're making real long-term allocation decisions even at these higher prices.
And these big buyers are trying to get a piece of a shrinking pie, right? Creating this supply shock effect.
Exactly right. While demand is surging, supply on exchanges is doing the opposite. The total amount of Bitcoin held on centralized exchanges, it keeps dropping. It's now at a 6-year low, just 2.83 million BTC.
What does that tell you?
It tells you holders are confident, they're pulling coins off exchanges, moving them into cold storage, planning to hold long term. This systematically shrinks the readily available supply. So when a big wave of demand hits like that $3.2 billion from the ETFs, the upward pressure on price gets amplified. Scarcity in action.
And are we seeing activity on the network itself, real usage supporting this rally?
We are, yeah. That's another healthy sign. We look at things like entity-adjusted transfer volumes. That's up 39%. Active addresses are up 11%.
So it's not just paper trading?
No, these metrics show the rally is backed by genuine economic activity. People are using the network, transferring value. It signals real adoption and utility growth, not just a bubble in the derivatives market.
Now, here's a weird one, almost counterintuitive. Retail interest. The general public. Apparently, they're barely paying attention.
Isn't that fascinating? Googled Friends data, looking at global searches for Bitcoin, it's near 5-year lows. It's like 4 times lower than the frenzy we saw back in 2020, 2021.
So mom and pop aren't FOMOing in this time.
Not yet, it seems. And that muted, kind of disengaged retail interest, that's actually seen by many analysts as a hallmark of a healthy, sustainable bull market.
How so?
It suggests this rally is being driven by institutional, maybe smarter, more patient money, not just mass speculation. It means we probably haven't hit that peak froth yet. The market is still climbing that proverbial wall of worry.
Okay, one more piece of the confidence puzzle. The miners. The guys actually securing the network, they're making huge investments right now, right? Big bets on the future.
Massive bets. This is one of the strongest indicators you can look at for long-term conviction. It's the industrial base of the network putting its money where its mouth is.
Give us some examples.
Well, you've got companies like Metavesco deploying brand new, super power-efficient miners, the Antminer S21 Plus models, boosting their hash rate by 9%.
Okay.
Or look at HIV Digital. They mined 267 Bitcoin just in September, and they're aiming to hit 25 exahash per second in mining power by U.S. Thanksgiving.
Why should we care about a 9% hash rate boost or hitting 25 exahash? What does that really signify?
Because buying and deploying these machines costs millions. Serious capital expenditure. These are fixed costs, huge investments in hardware and energy contracts.
Right.
They only make these bets if they're absolutely convinced the price of Bitcoin is going to be significantly higher for years to come to justify that massive upfront expense. Their entire business model depends on long-term price appreciation. It's a powerful vote of confidence.
So if you put it all together,
yeah,
you've got the macro story, the institutional floodgates opening via ETFs, the shrinking supply, the network growing, miners investing heavily. It really does sound like a potent recipe for price to keep climbing long term.
It's a powerful confluence, no doubt about it.
So what does this all mean for you, the listener, trying to navigate this? We've got this clear structural certainty, seemingly, against this immediate tactical chaos. For today, for the next 24 hours, what are the absolute key things you need to watch? The top 4 indicators.
Okay, laser focus needed today. Risk management is key. Number 1, the U.S. Senate shutdown votes. Tonight, October 6th evening. That's the biggest near-term thing. A resolution could mean instant pressure.
Got it. Number 2.
Price action around $124,000. We need to see that zone defended successfully. If it holds, it validates the breakout. If it fails, $120,000 or lower could be back on the table fast.
Okay. 3rd.
Daily spot Bitcoin ETF net flows. Watch the data that comes out later today. We need confirmation that institutional buying is still strong at these higher prices, that it didn't just pause.
Makes sense. And number 4.
Derivatives funding rates. Keep an eye on those in real time. They tell you how much leverage and speculative froth is in the system. If those rates stay really positive, that risk of a long squeeze remains extremely high.
Okay, so what does this all mean? Summing it up. The long view, the structural trend, clearly bullish. Institutions are here, scarcity is real, but the short term, it's like walking a tightrope over a pit of overbought signals and crazy leverage.
The absolute key is differentiation. You have to mentally separate the short-term noise, the tactical volatility, from the underlying durable long-term picture.
Right.
So any dip, any weakness, any volatility that's driven by something temporary, like eventually the government will reopen, that shutdown catalyst will go away.
Yeah.
That kind of price action shouldn't make you think the whole bull market is suddenly over. In fact, if you're a long-term investor, that kind of volatility driven by removing a temporary factor might actually be seen as a potential buying opportunity.
Yeah.
It doesn't break the main story of adoption and scarcity.